If you have set up a limited company and you are not sure how to pay yourself, you are not alone. This is one of the most common questions I get asked. Get it right and you can save thousands in tax every year. Get it wrong and HMRC will come knocking. I am going to break it down in plain English right now. When you run a limited company, you cannot just transfer money from the company bank account into your personal account whenever you feel like it. The company is a separate legal entity. Its money is not your money. There are 3 ways to legally take money out of your company, and most directors use a combination of all 3. The first way is salary. As a director, you can put yourself on the payroll and pay yourself a salary through PAYE, just like any other employee. Now here is where it gets interesting. Most tax-efficient directors pay themselves a low salary, just enough to qualify for national insurance credits without actually paying national insurance. For the current tax year, that is around £12,500 a year, or just over £1,000 a month. This keeps your personal tax bill low while still building your national insurance record for your state pension. The second way is dividends. This is where the real tax saving comes in. Once your company has made a profit and paid corporation tax on it, you can distribute the remaining profit to shareholders as dividends. You as the director are also likely the shareholder, so those dividends come to you. Dividends are taxed at a lower rate than salary. The first £500 of dividends you receive each year is tax-free. After that, you pay 8.75% on dividends within the basic rate band. Compare that to 20% income tax on salary, and you can see why dividends are so tax efficient. So the most tax-efficient approach for most small company directors is a low salary of around £12,500 a year, topped up with dividends from company profits. This combination keeps your overall tax bill as low as legally possible. The third way is a director's loan. You can borrow money from your own company. If you repay it within 9 months of the company's financial year end, there is no tax to pay. If you do not repay it, HMRC will charge the company a tax penalty, and you will pay income tax on the loan personally. Directors' loans can be useful for short-term cash flow, but they need to be managed carefully and recorded properly in your accounts. Do not use your company bank account as a personal piggy bank without understanding the rules first. I have seen people get into serious financial difficulty because they did not understand how directors' loans work. Now you do. One final point. Please use an accountant. Even a basic small business accountant charging £200 to £300 a year to do your company accounts and corporation tax return will save you far more than that in tax. The tax saving from getting your salary and dividends split right alone will pay for your accountant many times over. That is how you pay yourself from a limited company in plain English. Salary, dividends, and director's loans. Use them correctly and HMRC will have no issues with you. Inside the free community linked below, there is a guide on this with the current figures so you always have the right numbers to hand. Link is in the description. Subscribe for a new video every week, and I will see you in the next one.